For the past decade, retail investors have been aggressively warned that Bitcoin is a speculative asset with absolutely no intrinsic value. We were repeatedly told by the most powerful executives on Wall Street that interacting with decentralized networks would inevitably lead to financial devastation. But a highly coordinated reversal is currently unfolding across the entire traditional banking sector, and the very institutions that once dismissed this technology as worthless are now all engaged in a brutal, multi-billion-dollar fee war to dominate the underlying supply. Today, we reveal why Morgan Stanley has deployed an army of 16,000 financial advisors to capture your digital wealth, and why this institutional invasion poses a structural danger to the core foundation of Bitcoin itself. My name is DC, and you're watching the Coin Bureau. Now, to fully appreciate the magnitude of what is happening, we need to examine the documented history of Morgan Stanley's relationship with Bitcoin, because the institutional hypocrisy on display is genuinely extraordinary. Back in December of 2017, Morgan Stanley research analyst James Fawcett published a landmark note titled Bitcoin Decrypted, in which he argued that Bitcoin's true value could be zero. The core thesis of that analysis was that Bitcoin lacked interest rates, had no physical form, and possessed what he described as virtually no acceptance as a currency medium, which was actually shrinking at the time of publication. That note landed when Bitcoin was trading at approximately $14,400 per coin. Furthermore, the bank's own CEO, James Gorman, publicly declared that Bitcoin was, and I quote, by definition, speculative, warning that anybody who thought they were purchasing a stable investment was, in his words, deluding themselves. Those statements were deliberate, public declarations from the executive leadership of one of the most systematically important financial institutions on earth. And of course, they shaped the investment decisions of millions of retail participants. Now fast forward to April 8th, 2026, when Morgan Stanley officially launched the Morgan Stanley Bitcoin Trust under the ticker MSBT on the New York Stock Exchange ARCA, directly entering the spot Bitcoin ETF arena with its own proprietary product, representing the first time a major systematically important United States commercial bank has issued a spot Bitcoin ETF on its own brand name. Multiple credible outlets, including Bloomberg, Reuters, and FinTech Weekly, confirmed this distinction on the day of launch. This complete transformation took approximately 9 years, from arguing that Bitcoin's value was zero to offering the cheapest access product on the market. And the bank's global head of ETFs, Alison Wallace, stated explicitly that they wanted to show their commitment by having that lower fee, adding that this is an asset class that is not going away. But this reversal has nothing to do with a genuine philosophical evolution regarding decentralized technology. No, sir. Morgan Stanley does not suddenly believe in peer-to-peer electronic cash or financial sovereignty. The reality is that Morgan Stanley witnessed over $30 billion flow into competing Bitcoin ETFs within the first year of the January 2024 SEC approval. And they calculated that the management fees being captured by BlackRock and Fidelity represented revenue that rightfully belonged on their balance sheet. This creates a situation where the institution that warned you away from Bitcoin for nearly a decade is now positioning itself as your primary gateway into the asset. And they are doing so with a pricing strategy specifically engineered to eliminate the competition. MSBT launched with an annual expense ratio of just 0.14%, which is the lowest among all United States spot Bitcoin ETFs currently available. Put simply, Morgan Stanley is not competing on brand recognition or analytical expertise. They are deploying a predatory pricing strategy designed to undercut every established player in the market. To contextualize the scale of this undercutting, consider the differential against BlackRock's IBIT, which charges 0.25%. For an institutional allocator deploying $10 million into a Bitcoin ETF, that 11 basis point gap translates to $11,000 in annual savings. Now, of course, $11,000 on a single allocation might sound marginal, but when you multiply that differential across thousands of high net worth accounts and hundreds of billions in potential client capital, the aggregate fee capture becomes absolutely enormous. And this is precisely the strategic calculation that Morgan Stanley is making. They are not offering the cheapest product because they want to democratize access to Bitcoin for the average citizen. They are offering the cheapest product because it functions as a calculated loss leader, a deliberate sacrifice on per unit margin designed to monopolize the total volume of institutional Bitcoin custody. And it looks like their approach is working.
Right, folks, a quick interlude because I think you're going to want to know this as well. Now, a lot of people still think Coinbase is just a beginner platform, but with Coinbase Advanced, that's actually changed quite a bit. You're getting lower fees, proper charting tools, real-time order books, and full control with limit and stop orders. So it all feels much closer to a professional trading setup, but without the usual complexity. So whether you're stepping up from basic apps or just want a cleaner, more reliable platform, it is definitely one to have on your radar. And if you want to try it out, there's currently a limited offer for Coin Bureau viewers. You can get $40 in Bitcoin when you trade $40. Now, this is available in the US, Canada, Europe, Singapore, and Australia, but it's capped to the first 350 people, so it may not last long. You can scan the QR code on screen now or check the link in the description and pinned comment for full details. And with that, let's get back to it.
On its very first day of trading, MSBT attracted approximately $30.6 million in net inflows and generated roughly $34 million in total trading volume. Bloomberg senior ETF analyst Eric Buchanan categorized that debut performance in the top 1% of all ETF launches over the preceding year. Furthermore, analyst projections suggest MSBT could reach $5 billion in assets under management within its first 12 months of operation. You might assume that this fee war is simply a healthy competitive dynamic that benefits the retail investor through lower costs. But that assumption completely ignores the distribution weapon that Morgan Stanley possesses, one that fundamentally separates it from every other player in the Bitcoin ETF landscape. Morgan Stanley operates a wealth management division overseeing approximately $6.2 trillion in client assets, serviced by a network of roughly 16,000 financial advisors. This is the critical detail that transforms MSBT from a competitive ETF product into a vertically integrated capital capture machine. BlackRock and Fidelity are asset managers. They manufacture investment products and distribute them through third-party brokerage platforms. Morgan Stanley manufactures the product and controls the advisory relationship with the end client. Those 16,000 advisors sit across from high-net-worth individuals every single day, making personalized investment recommendations that carry the full institutional weight of one of Wall Street's most recognizable names. Prior to the MSBT launch, these advisors were authorized beginning in August of 2024 to recommend third-party Bitcoin ETFs, specifically BlackRock's IBIT and Fidelity's FBTC to eligible clients. This means that Morgan Stanley was essentially funneling its own client capital into a competitor's fee-extracting product. And now, with MSBT available as a proprietary offering, every single one of those advisory conversations becomes an opportunity to redirect management fee revenue directly onto Morgan Stanley's income statement. Bloomberg analysts specifically identified this captive audience of thousands of advisors as the bank's primary competitive advantage over incumbents who lack this direct-to-client advisory channel. And the data confirms that this advisory activation represents entirely new demand. Approximately 80% of crypto ETF activity on the Morgan Stanley platform historically came from self-directed investors making their own decisions. The advisor network is the untapped reservoir, and it is now fully operational. This creates a pipeline where a single institution controls the advisory recommendation, the proprietary product, the fee collection, and ultimately the custodial relationship with the underlying Bitcoin. And this is where the analysis must shift from competitive dynamics to something far, far more consequential for the entire future of decentralized finance. While mainstream financial media celebrates these massive ETF inflows as validation for Bitcoin's price trajectory, they are completely ignoring the structural danger embedded in this institutional accumulation. Every single Bitcoin absorbed into the Morgan Stanley Bitcoin Trust or into BlackRock's IBIT or into any of these centralized custodial vehicles is a Bitcoin permanently removed from the decentralized peer-to-peer economy. By August of 2025, BlackRock's IBIT alone held approximately 745,000 Bitcoin, which represented roughly 3.5% of Bitcoin's total circulating supply, surpassing even the exchange reserves held by Coinbase and Binance. Furthermore, the total US spot Bitcoin ETF market collectively controls an estimated 5.7% of Bitcoin's entire supply. And that percentage is growing with every single trading day. But the concentration risk extends beyond just the ETF issuers themselves. Coinbase CEO Brian Armstrong stated in February 2026 that his company custodies over 80% of all US Bitcoin and Ethereum ETF assets. That means a single corporate custodian is responsible for safeguarding the overwhelming majority of institutionally held Bitcoin across virtually every major ETF product on the market, including Morgan Stanley's MSBT. Analysis from CryptoSlate documented that Coinbase holds approximately 1.5 million Bitcoin tied to ETF custody arrangements, representing roughly 7% of Bitcoin's maximum supply concentrated under one roof. A single operational failure, a single regulatory action, or a single security breach at the custodian could simultaneously disrupt the holdings of BlackRock, Fidelity, Morgan Stanley, and dozens of other fund managers. As CryptoSlate noted, custody is supposed to be boring, but concentration risk makes every bad quarter feel like a stress test. This creates a paradox that Cointelegraph articulated precisely when they observed that the decentralized asset is increasingly controlled by centralized institutions. And this brings us to the ultimate structural trap that these legacy financial products represent for the individual investor. When you purchase Bitcoin through a spot ETF like MSBT, you do not own Bitcoin. You own a share in a trust that holds Bitcoin on your behalf, managed by Morgan Stanley, custodied by Coinbase, and administered by BNY Mellon. You cannot transfer that Bitcoin to a self-custody wallet secured by your own private keys. You cannot deploy a wrapped version of that Bitcoin into DeFi protocols to generate yield or provide liquidity. And you certainly cannot conduct a single peer-to-peer transaction, which is the fundamental capability described in the very first sentence of Satoshi Nakamoto's white paper. In other words, you are locked inside a walled garden where the bank dictates exactly when and how you can access the economic value of your own holdings. And they extract a perpetual management fee for the privilege of that restriction. Not your keys, not your coins. That principle is the foundational security architecture of Bitcoin. And every dollar flowing into these institutional products represents a voluntary abandonment of that architecture. The endgame becomes visible when you trace the complete vertical integration that Morgan Stanley is currently constructing. In February of 2026, the bank applied to the Office of the Comptroller of the Currency for a National Trust Bank charter for a proposed entity called Morgan Stanley Digital Trust National Association. That application covers digital asset custody, fiduciary staking, and token transfers, positioning Morgan Stanley to eventually become its own Bitcoin custodian, eliminating even the dependency on Coinbase. They are simultaneously planning to launch direct spot trading of Bitcoin, Ethereum, and Solana on their E-Trade platform through infrastructure provided by Zero Hash, a company in which Morgan Stanley invested during a $100 million funding round. So, to put it simply, Morgan Stanley is not merely offering a Bitcoin ETF. They are systematically constructing a complete institutional capture architecture that encompasses the advisory recommendation, the investment product, the custodial infrastructure, and the retail trading platform. Every single layer of that architecture extracts fees. Every single layer removes Bitcoin from circulation, and every single layer concentrates control over a permissionless asset inside the exact type of institution that Bitcoin was originally designed to circumvent. By embracing these institutional products, retail investors are voluntarily handing the keys of the financial revolution back to the very banks whose failures precipitated the 2008 crisis, the crisis that inspired the creation of Bitcoin in the first place. So the launch of the Morgan Stanley Bitcoin Trust is not a moment for the crypto community to celebrate. It is a warning that the legacy financial system has recognized it cannot destroy decentralized technology, so it has chosen to absorb it instead. By weaponizing the lowest fees in the market and activating thousands of wealth advisors who collectively oversee trillions and trillions in client capital, they are centralizing the supply of the world's most pristine digital commodity. When the overwhelming majority of Bitcoin sits inside institutional cold storage vaults, operated by a handful of corporate custodians, the revolutionary promise of peer-to-peer electronic cash is fundamentally compromised. The traditional banking cartel is actively constructing a velvet trap, and millions of investors are walking directly into it. But what do you think? Will the convenience of these ultra-low fee ETFs ultimately erode the foundational ethos of self-custody? Or will the underlying decentralized network remain resilient despite this massive institutional accumulation? Please get highly opinionated in the comment section below. And if you want to understand exactly how these same legacy banks are lobbying Congress to restrict stablecoin yields for everyday users, you must definitely check out our deep dive video right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing off.